$86.68. That's where silver is trading right now, today, March 11th, 2026. And I know what you're thinking. That's not even close to the all-time high, so what's the big deal? Stick with me because the number I actually need you to focus on isn't 86.68. The number that should be keeping you up at night is 14.55%. That is the premium gap between what physical silver is trading for right now in Shanghai versus what the paper price on COMEX is showing you on your screen. 14.5%. Two markets, same metal, same moment in time, and one of them is lying to you. And by the end of this video, you're going to know exactly which one, exactly why, and exactly what the smartest money in the world is doing about it right now. Because here is the thing that most people scrolling through financial headlines completely miss. The price you see quoted everywhere, on financial news sites, in your brokerage app, on CNBC, that price comes from COMEX in New York, a paper futures exchange where, and I want you to hear this very carefully, fewer than 1% of contracts ever result in actual physical silver changing hands. 1%. The other 99% are settled in cash. So you are watching a market price silver based almost entirely on paper promises, while on the other side of the planet in Shanghai, a completely different market is pricing physical silver. Bars you can actually hold, bars that get delivered, bars that industrial manufacturers are desperately trying to get their hands on. And that market is saying silver is worth significantly more than what COMEX is telling you. That gap right now is 14.55%. And that gap is not random noise. That gap is a signal. Let me give you some context because this story starts way before today's price action. To understand what's happening right now on March 11th, 2026, you have to understand what happened 6 weeks ago, because it was one of the most extraordinary events in commodity market history. On January 29th, 2026, silver hit an all-time high of $121.62 per ounce. That's not a typo. $121. The previous all-time record had stood for 45 years. It was set by the Hunt brothers in 1980 at $49.95. Silver didn't just break that record, it more than doubled it. And then, within literally 30 hours, the whole thing collapsed. Silver crashed from $121 down to below $75. A 31.4% single-session decline, the worst single day for silver since March 1980. The CME Group, which runs COMEX, raised margin requirements on silver futures that same weekend, and the forced liquidations were catastrophic. Anyone holding leveraged paper positions got wiped out. It was a bloodbath. But here's the thing that almost nobody is talking about. While the paper price was crashing 31%, what do you think was happening in the physical silver market? Because I checked, and the answer is deeply revealing. Quick message for those of you who aren't subscribed yet. My analytics show about 3 out of 4 people watching right now have never hit that subscribe button. If this kind of analysis, going past the headlines and into the actual data, is useful to you, subscribe. That's literally the only signal that tells me this community wants more of this content. It also helps the algorithm show this video to more people who need to see it. Takes 2 seconds. Now back to the story because this next part is critical. While COMEX silver was imploding, premiums on physical silver coins and bars at dealers actually went up. Not down, up. Industrial buyers who needed real metal weren't panicking, they were buying. The Silver Institute projects that physical investment demand will rise 20% in 2026, hitting 227 million ounces, a 3-year high. And here's the thing that should tell you everything. Since that crash on January 30th, silver has clawed all the way back. It was at $83.96 on March 9th, $88.28 on March 11th this morning, before settling back to our video's opening number. The paper market got crushed. The physical market barely blinked. One of those markets understands something the other one doesn't. And what that something is the whole point of this video. Let me show you the framework, because this pattern isn't new. The divergence between what paper markets say and what physical markets know. This has played out in history before, and it always ends the same way. In 2008, right before the financial crisis hit, credit default swap prices were flashing extreme stress, while equity markets were still near all-time highs. Two markets, same underlying reality, two completely different pictures. The paper equity market was wrong, the credit market was right. Or go back to 1999 to 2000. Internet company stocks were trading at valuations disconnected from any physical business fundamentals. Meanwhile, people who owned actual productive assets, real estate, physical businesses, were pricing things very differently. The paper market was wrong again. Here's the pattern. Paper markets can ignore physical reality for months, sometimes years. But eventually, physical reality wins. Every single time. The only question is how violent the correction is when the two prices converge. Right now, you have two markets pricing silver. COMEX paper is around $74 to $88 depending on the session. Shanghai physical is running approximately 14.5% higher. Every day that gap stays open, and it has been staying open, is another day of accumulated evidence that the physical market knows something the paper market is pretending doesn't exist. Now let me pile on the evidence because this is where the story gets undeniable. Start with the most basic number: global supply versus global demand. According to the Silver Institute, in 2025, total global silver demand reached an estimated 1.24 billion ounces. Total supply, that's all mine production plus all recycling combined, came in at approximately 1.01 billion ounces. That's a deficit of over 230 million ounces in a single year. Now multiply that across 5 consecutive years. That's right, for 5 straight years the world has consumed more silver than it has produced. The cumulative 5-year shortfall has now topped 800 million ounces. To put that in perspective, 800 million ounces is roughly equal to the entire annual output of Mexico, the world's single largest silver-producing nation, for an entire year. Gone, consumed, not coming back. And here's why you can't just drill your way out of this problem. About 75% of all silver mined in the world is produced as a byproduct of mining other metals: copper, zinc, lead. Higher silver prices don't automatically turn on more silver mines because the economics of those base metal operations don't change just because silver is expensive. The other 25%, the primary silver mines, they face permitting timelines of 5 years or more just to bring a new project online. Mine production is expected to grow just 1% in 2026 to approximately 820 million ounces globally. Meanwhile, demand is roaring. You do the math. The Silver Institute projects a 67 million ounce deficit for 2026 alone. That would be the 6th consecutive year of structural deficit. But it gets worse. And I mean significantly worse. On January 1, 2026, China quietly pulled a lever that sent shockwaves through every silver trading desk on the planet. China implemented new export restrictions on refined silver, effective immediately, requiring government licenses for any company that wants to ship silver out of the country. And not just any license. To qualify, your company must produce at least 80 tons of silver annually and maintain credit lines of no less than $30 million. What that requirement does is effectively eliminate every small and medium-sized silver exporter in China from the international market. According to CNBC, Beijing released a list of just 44 approved companies to export silver for 2026 and 2027. 44 companies. That's it. China controls between 60 and 70% of the world's refined silver supply, and they just locked most of it inside their borders. Elon Musk, responding on X, wrote, "This is not good. Silver is needed in many industrial processes." That's an understatement. The US government designated silver as a critical mineral in November of last year, and the country that controls 2/3 of global silver refining capacity just classified it as a strategic material, placing it on the same regulatory footing as rare earths. The same playbook China ran with rare earth metals that sent industries scrambling. The same playbook they ran with tungsten and antimony. If Chinese exports dropped by just 50%, analysts project annual global deficits could exceed 5,000 metric tons. 5,000 metric tons of deficit on top of the structural deficit that already existed. This isn't a silver story anymore. This is a geopolitical chess move. Now let me show you what this is doing to the actual vaults. COMEX registered silver. And I need you to understand this distinction because it matters enormously. Registered silver is the metal that is actually tagged, warranted, and available to be delivered against a futures contract. It's the real, deliverable pile. Eligible silver, which makes up the majority of what's reported in COMEX vaults, is silver that's being stored there but that the owner hasn't made available for delivery. It could be sold to you at any price. It could never be available. You don't know. Registered COMEX silver has declined over 80% from its 2021 peak. Let that sink in. 80%. On February 11th of this year, official COMEX depository statistics confirmed that registered silver fell below the 100 million ounce threshold for the first time in years. A single-day negative adjustment of more than 3,250,000 ounces in the registered category alone. At the current withdrawal pace, one market monitoring service estimates registered silver would be exhausted in approximately 70 trading days. And in a single week in January, just 7 days, 33.45 million ounces of silver were physically withdrawn from COMEX for delivery. That is 26% of the entire registered inventory, gone in 1 week. 1 week. Meanwhile, open interest in the March 2026 futures contract sat between 85,000 and 91,000 contracts, representing a theoretical delivery obligation of 425 to 455 million ounces of silver, against registered inventory of less than 100 million ounces. The coverage ratio, the percentage of outstanding paper claims that could actually be satisfied with deliverable metal, is now sitting at 14%. Below 15% is considered stress territory. We are in stress territory. Here's what makes this truly alarming. COMEX isn't the only vault draining. London, the LBMA, has seen its eligible silver stocks described as critically low. 1-month silver lease rates in London surged to around 7 to 8%. Let me translate that for you. Lease rates are what you pay to borrow silver. In a normal market, lease rates are fractions of a percent. When lease rates hit 7 or 8%, it means institutions are paying enormous premiums just to borrow metal to cover short positions because there isn't enough silver available to buy outright. At 7 to 8% lease rates, the math of shipping silver from New York to Shanghai to capture the price premium stops working. The shipping, insurance, and borrowing costs eat the spread, so the gap between Shanghai and COMEX can stay wide, and stay wide for a long time, not because anyone is asleep at the wheel, but because the physical arbitrage to close it is literally too expensive. Shanghai inventories on the Shanghai Futures Exchange have declined 43% from November 2025 levels to February 2026. Shanghai Gold Exchange inventories hit their lowest level since 2015 earlier this year. There is no warehouse anywhere in the world that is filling up with silver right now. Every major storage system, east and west, is emptying. Stick with me because I want to show you the smoking gun. This is the part where the disconnect between paper and physical becomes mathematically impossible to explain as anything other than a market that is fundamentally broken. At the beginning of January this year, the COMEX March 2026 futures contract was trading at $72.26. At the exact same time, in Dubai, not even Shanghai, the lowest price you could pay for a physical silver coin was $99.93. That's a spread of nearly $28 per ounce. $27.67 to be precise. Between the paper price at the world's largest silver futures exchange and what you actually had to pay to hold real silver in your hand. Rich Chekin, president and COO of Asset Strategies International, said it directly to the Investing News Network in early January. There is no doubt that the bifurcation between the paper silver market and the physical silver market will be expanded. Currently, the ratio of paper silver contracts to real, physical ounces of silver is 356 to 1. 356 paper claims for every single ounce of real, physical silver. This isn't a fractional reserve system, this is a house of cards, and the people who know what's happening are acting on it. In the February delivery cycle, COMEX saw 5,036 contracts physically delivered, 25.18 million ounces, the highest February delivery volume in modern COMEX history. Traders aren't rolling their positions to the next month anymore, they're demanding the metal now. They're insisting on taking those silver bars into their own custody. They don't trust that the metal will be there later. Now let me ask you something. When you have a market where paper contracts are 356 times the physical metal, where registered inventory is down 80% from peak, where lease rates are at 7 to 8%, where institutional players are demanding delivery at record rates, where a vault monitoring service says inventories could be exhausted in 70 trading days at current pace, what does it mean when the price on that exchange is still the number the whole world uses to value silver? It means the whole world's pricing mechanism for silver may be based on a fiction, and Shanghai knows it. That's why Shanghai is pricing silver 14.5% higher, because the buyers and sellers in Shanghai are dealing in physical metal, and the physical market is screaming that supply is far tighter than the COMEX ticker is suggesting. It's like two gas stations on the same block. One is posting a price of $4 a gallon but is completely out of gas, and the other is actually selling you gas but at $4.65. Which one is telling you the truth about what gas is actually worth? Let me name some names because this isn't abstract. JP Morgan's registered silver pile in COMEX vaults has been effectively cut in half from earlier levels, down to a mere 16.8 million ounces. JP Morgan, the bank that was fined over $900 million in 2020 for years of illegal manipulation of the silver and gold futures markets. The bank whose traders pleaded guilty to racketeering charges for spoofing, placing enormous fake orders to move prices before canceling them. They cut their registered silver position in half. They know what the vault data shows. They are not standing in the way of physical delivery. Citigroup has a price target of $150 per ounce for silver in Q2 of 2026, citing tightening physical supply. Deutsche Bank has a year-end target of $100. Meanwhile, the paper market is sitting at $86.68. These are the same institutions whose analysts look at this data every day. What they're seeing is exactly what I've been walking you through: a paper price that has repeatedly disconnected from physical reality, and a coiled spring of physical demand that keeps snapping prices back up every time the paper market gets slammed down. Remember, silver crashed 31% on January 30th. 6 weeks later, it had recovered almost all of it. The paper market knocked it down. Physical demand pulled it back up. The tug of war is visible in real time. So what does all of this mean for you specifically? Not for hedge fund traders, not for institutional investors, for you. First, understand what the Shanghai gap is actually telling you. When physical silver in Asia is persistently and significantly more expensive than paper silver in New York, that is the physical market sending a price signal that the paper market is either unable or unwilling to reflect. History says the physical market wins these standoffs. The paper market either catches up or the paper market breaks. Either way, the paper price goes higher. Second, if you own silver ETFs or paper silver products, understand what you actually own. You own a claim, not metal. Most silver ETFs hold paper exposure, not allocated physical bars in your name. In a market where the paper-to-physical ratio is 356 to 1, you need to be very clear about whether you hold silver or a promise of silver. Those are very different things right now. Third, the timeline based on historical patterns. Every single time COMEX has faced this kind of stress, inventory drawdowns, lease rate spikes, physical premiums, rising delivery demands, the paper price has eventually repriced sharply higher. The 2011 run to nearly $50 came from far less structural stress than exists today. The January 2026 run to $121 demonstrated that when physical reality finally bleeds into the paper market, it can happen extremely fast. 30% up in a month, then 31% down in a day, then most of it back in 6 weeks. This metal is moving violently because the price discovery mechanism is broken. Fourth, supply will not rescue this market quickly. With 75% of silver production dependent on base metal mining economics, no increase in silver prices automatically turns on more production. New mines take 5 years minimum to permit. The deficit is structural, not cyclical. There is no quick fix. Fifth, the geopolitical dimension has permanently changed the market. China reclassified silver as strategic on the same day the US designated it a critical mineral. Both of the world's largest economies are treating silver like it's something you need to control, not just trade. That's a new reality that has no historical precedent in modern silver markets. Sixth, watch the COMEX stress indicators. The coverage ratio, right now at 14%, is your warning gauge. Below 15 is stress territory. If that number keeps falling, you're watching the clock tick toward a potential forced cash settlement or delivery failure event. Analysts have called the March 2026 contract the first likely casualty. Watch what actually happens as the March 27th settlement date approaches. And seventh, I want to be clear here and say this is not financial advice. I'm not a financial advisor, I'm a researcher and commentator. Every person's financial situation is different. What I'm giving you is data and context, not a recommendation. Do your own research, talk to a qualified professional, but please, do the research, because what I've just walked you through is documented in official COMEX filings, CME Group delivery reports, Shanghai Gold Exchange data, and statements from major banks like Citigroup, Deutsche Bank, and JP Morgan. This is not speculation. Let me bring this full circle because I want to leave you with the complete picture in one clean summary. On January 29, 2026, silver hit $121.62, a new all-time record. Within 30 hours, the CME raised margin requirements and forced liquidations, cratered the paper price 31% in a single day. That was the paper market winning the battle. But not the war, because the physical market didn't follow. It kept buying. And now, 6 weeks later, silver is back at 86.68 and climbing, with the physical price in Shanghai running 14.5% above COMEX, the widest persistent gap in recent memory. Behind that gap, a 5-year, 800 million ounce cumulative deficit, a 67 million ounce projected shortfall for 2026 alone. COMEX registered silver down 80% from peak, coverage ratio at 14%, stress territory, 1-month lease rates at 7 to 8%, China locking down 60 to 70% of the world's refined silver supply behind export licenses, Shanghai inventories at decade lows. London inventories critically depleted. A 356 to 1 paper to physical ratio. And record physical delivery demands inside COMEX itself. Institutions demanding real bars right now because they're not sure the bars will be there later. People who held paper silver in January got wiped out on January 30th. The people who held physical metal watched their price go from $70 to $121 and back, and never had to do anything. Because physical metal doesn't get margin called. Physical metal doesn't get force liquidated. Physical metal just sits there reflecting reality, and right now physical market reality is 14.5% more expensive than what the ticker is telling you. The people who ignored these signals in 2011 watched silver go from $30 to almost $50 in 4 months. The people who ignored these signals at the end of 2025 watched silver triple from $30 to $100. The signals are there again. They're louder than they've ever been. The Shanghai gap is the market telling you something. Whether you listen is entirely up to you. Drop a comment and tell me, are you watching the Shanghai premium as a price signal, or do you think the COMEX price is the one to trust? I want to know how you're interpreting the gap. I read every single comment. The conversation down there is genuinely some of the sharpest analysis I see anywhere, and your perspective shapes what I dig into next. And if you want to go deeper on this specific story, I'm working on a follow-up piece specifically on what happens if the March 2026 COMEX delivery cycle runs into a physical shortage. The numbers, the mechanisms, and what cash settlement actually means for silver price discovery. That video is coming. Make sure you're subscribed so you don't miss it when it drops. This is one of the most important stories in the commodities market right now. The Shanghai gap is not noise, it's a signal, and the data says it's getting louder.